Hello students, welcome to my class. I am Vasantha TD, working as Associate Professor and HOD, Department of Commerce and Management, Government First Aid College, Tumkur. Today I will be teaching on the concept of dividend decisions for the 4th SEM BBM and BCOM of Tumkur University. Now I will talk about the meaning of dividend, dividend policy, determinants of dividend policy, and types of dividend. Let us begin the introduction of dividend decision. Dividend decision of the firm is vital area of financial management. The significant aspect of dividend policy is to decide the amount of earnings to be distributed to shareholders and the amount to be retained in the firm. Dividend policy involves harmonizing of the shareholders' desire for current dividends and the firm's needs for funds for growth. Now I am focusing the meaning of dividend. The term dividend refers to that division of profits of a company which is distributed by the company among its shareholders. It is the reward of the shareholders for investments made by them in the shares of the company. According to the Institute of Chartered Accountant of India, dividend is defined as a distribution to shareholders out of profits or reserves available for this purpose. Now I am focusing types of dividend. Types of dividend, with regard to types of dividend, we can come across four types of dividend. The first one is cash dividend. A cash dividend is a usual method of paying dividend. Payment of dividend in cash results in the reduction of outflow of funds and reduces the net worth of the company. The shareholders get an opportunity to invest the cash in any manner they desire. Dividend paid by the company to its shareholders in the form of cash is known as cash dividend. Hence, the ordinary shareholders prefer to receive dividends in cash. In case of companies having cash dividends, the firm must have adequate liquid resources so that its liquidity position is not adversely affected on account of cash dividend. The second thing is that scrip or bond dividend. A company may not have sufficient funds to issue dividends in the near future. So, instead of it issues a scrip dividend, which is essentially a promissory note to pay shareholders at a later date. When the earnings of the company ensures that the shareholders can be paid dividend, but the cash position is temporarily weak, in such a situation, company issue promissory note which may or may not be interest bearing. The shareholders can encash these promissory notes on the maturity. The company can declare scrip or bond dividend only when it has earned profits. Third one, property dividend. A company may issue a non-monetary dividend to investors rather than making a cash or stock payment. Property dividends are paid in the form of some assets other than cash. These are distributed under exceptional circumstances and are not popular in India. The fourth type is stock dividend. Stocks dividend means the issue and the bonus shares to the existing shareholders. If a company does not have liquid resources, it is better to declare stock dividends. Stock dividend amounts to capitalization of earnings and distribution of profits among the existing shareholders without affecting the cash position of the firm. Now I am focusing the factors determining dividend policy. The first point is that profitable position of the firm. Dividend decision depends on the profitable position of the business concern. When the firm earns more profits, they can distribute more dividends to shareholders. The second point is that uncertainty of future income. Future income is a very important factor which affects the dividend policy. When the shareholders needs regular income, the firm should maintain regular dividend policy. Third point is that contractual constraints. This means often the firm's ability to pay cash dividend is constrained by restrictive provisions in a loan agreement. Generally, these constraints prohibit the payment of cash dividends until a certain level of earnings have been achieved, or they may limit dividends to a certain amount or a percentage of earnings. Constraints on dividends help to protect creditors from losses due to the firm's insolvency. The violation of a contractual constraint is generally grounds for a demand of immediate payment by the fund's supplier. The fourth factor is that internal constraints. The firm's ability to pay cash dividend is generally constrained by the amount of excess cash available rather than the level of retained earnings against which to charge them. Although it is possible for a firm to borrow funds to pay dividends, lenders are generally reluctant to make such loans because they produce no tangible or operating benefits that will help the firm repay the loan. Although the firm may have higher earnings, its ability to pay dividends may be constrained by a low level of liquid assets. The fifth point is that growth prospects. The firm's financial requirements are directly related to anticipated degree of asset expansion. If the firm is in a growth stage, it may need all its funds to finance capital expenditure. Firms exhibiting little or no growth may never need replace or renew assets. A growth firm is likely to have depend heavily on internal financing through retained earnings instead of distributing current income as dividends. Sixth point is that owner consideration. In establishing a dividend policy, the firm's primary concern normally would be maximizing shareholders' wealth. One such consideration is then tax status of firm's owners. Suppose that if a firm has a large percentage of wealthy shareholders who are in a high tax bracket, it may decide to pay out a lower percentage of its earnings to allow the owners to delay the payment of taxes until they sell the stock. Of course, when the equity shares is sold, the proceeds are in the excess of the original purchase price. The capital gain will be taxed possible at a more favorable rate than the one applied to ordinary income. Lower income shareholders, however, who need dividend income will prefer a higher payout earnings. As of now, the dividend income is not taxed in the hands of the shareholders in India. Instead, for paying out such dividend to its shareholders, the company bears the dividend distribution tax. There are so many points out there. Among those points, other points such as market considerations, legal constraints, liquidity position, sources of finance, growth rate of the firm, tax policy, and capital market considerations. So these are to be observed by the departmental manager while considering the dividend distribution aspect. Now, I will conclude that the payment of dividend involves some legal as well as financial considerations. It is difficult to determine a general dividend policy which can be followed by differ, different firms at different times because dividend decision has to be taken considering the special circumstances of an individual case. For more details on factors determining dividend policy, I will be sharing notes with you all. Thanking you.